Hedging phrases for PE calls, strategic English for investors. Wondering why seasoned investors hedge their language on PE calls? Smart hedging signals prudence under uncertainty. You're showing judgment, not hesitation. It lets you keep options open without sounding weak, so you can adjust as facts evolve. Thoughtful caveats protect relationships and valuation talks by avoiding hard lines you might need to walk back later. And good hedges bridge data gaps before diligence, buying time to verify assumptions. In short, hedging communicates that you're rigorous, realistic, and collaborative. Exactly what counterparties want when stakes are high and information is incomplete. Use gentle soft openers to set context. At this stage, based on current views. These signal early thinking, not final conclusions. Add probability language, likely, appears, we expect, to calibrate confidence. Set boundaries to avoid over-precision, within a range of, subject to, operational or market assumptions. Anchor claims and evidence, per initial comps, early reads suggest. This mix frames your view as data-informed and provisional, helping listeners track where confidence is firm and where it depends on upcoming checks. For numbers, be specific yet cautious. Example: indicatively, we see EBITDA in the XY range. That offers direction without overcommitting. Forecasts benefit from dependencies. Our base case points to mid-teens growth, contingent on churn. Signal opportunity without promise. Near-term margin upside looks plausible, pending pricing tests. Don't forget risk flags. Weed flag risks around input costs and CAC inflation. Each line pairs a view with a condition, so your counterpart understands what must be true for the outcome to hold, and where valuation sensitivity sits. Pre-diligence. Mark the limits clearly. Try. Pre-DD view. Numbers may normalize post-QOE. That acknowledges adjustments after quality of earnings. Scope data gaps. Limited visibility into cohort retention past month 12. If stability depends on externals, say so. Supply chain seems stable, barring FX volatility. Always propose the next validation step. We can firm this up after customer calls and skew analysis. These caveats keep credibility high and prevent misreads while guiding the room toward the evidence that will resolve open questions. You can resist pressure while staying collaborative. Shift the frame. Open to exploring structure rather than headline price. Tie acceptance to alignment. Could work if earnout aligns with retention milestones. Acknowledge constraints but offer momentum. Timing feels tight. We can accelerate critical work streams. Keep the conversation alive with a checkpoint. Happy to revisit once we see April actuals. Each line protects your position, proposes a practical path forward, and preserves goodwill. Key when you may be negotiating with the same people for weeks. Ground your view in market context without overclaiming. Category fit matters. This looks closer to vertical SaaS than general B2B. Calibrate expectations. Multiples appear to be compressing X-topped decile. Identify likely buyers. Buyer universe likely skews to strategics given synergies. And flag financing constraints. Debt markets supportive, subject to leverage caps. These statements show you're watching comps, quality tiers, buyer logic, and credit conditions, helping set realistic valuation ranges and deal structures while inviting the other side to compare notes. Make every hedge useful. First, pair hedges with one concrete data point, a metric, comp, or test, to anchor credibility. Avoid overhedging. One clear caveat per claim keeps you decisive. Name the path to certainty. Specify what analysis, who owns it, and by when, so the room knows how risk converts to knowledge. Finally, mirror the counterpart's language, their terms for churn, cohorts, or margins, to build alignment fast. The goal isn't to blur accountability, it's to balance clarity with realism, guiding listeners from today's estimate to tomorrow's evidence. Take a blunt claim and make it rigorous. Strong, revenue will double. Better, on preliminary data, revenue could double by Q4, subject to churn control. See the pattern? Use the template. Opener plus cautious verb plus range plus dependency. For example, at this stage, we expect 12 to 18% arranged by growth, assuming renewal rates hold. The key takeaway: hedge to signal rigor, not doubt. You're showing what would make the result happen and what might prevent it, which boosts trust and keeps the conversation productively evidence-driven.